Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Kevin Rendino, CEO and portfolio manager of Nasdaq-listed 180 Degree Capital, with his outlook on small and microcap stocks. Kevin, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Good to see you.
You've done some historical analysis that points to small caps being the only major equities asset class to outpace inflation. Why is that?
Well, since the 30s, it is the only asset class to outpace inflation every single decade, and it's the only asset class that outpaces inflation when inflation is over 5%. A lot of reasons. One of them is which, for the most part, they're isolated and insular, and so they don't deal with the same supply chain issues that many of the global macro companies participate in. So they're just insulated from the inflation that you're seeing around the globe. They're also nimble, and many of these small cap management teams are able to quickly pass inflation along to their through to customers because they're so nimble and they're able to grow faster, and so they're just able to pass the costs along much quicker than a global multinational company can.
Where are we in the cycle now that the Fed has started to raise rates?
So I think we're at peak everything. I think we're at peak volatility. I think we're at peak inflation. I think we're at peak fears in terms of where consumer confidence numbers are. And so I think from here it gets better as you look out the next year rather than get worse. I think most of the inflation that we're seeing is COVID related. Many countries around the globe have vaccination rates that are far less than the United States. Unfortunately, we import too many products from many of these Asian companies. And as we get back to normal, and as many of these countries sort of move back from the stay-at-home orders, which in some cases are still in existence, we think there'll be more normalization of inflation as we go forward. I think it's mostly COVID related, and this last bout of inflation that we're seeing really started Thanksgiving week when Omicron started, and that variant obviously reared its ugly head, and we've seen that for the last 3 or 4 months. So demand's been great, but unfortunately, companies and countries are still don't have the same vaccination rates that we do, and it's just a mess out there. But I think we're at the peak part of that problem today. As I look out a year from now, I think there'll be much greater relief.
Small caps have certainly taken a sizable hit, and you believe that oversold names have created opportunities. Where are you finding bargains and opportunities to put money to work?
Yeah, so there's many companies that we own that have traded down significantly on air because we're in a risk-off environment. So there's companies like Synchronous, which does personal cloud software for Verizon and AT&T. They have nothing to do with supply chain issues. It's a 90% of their business is recurring. It's a domestic business. You don't have to worry about supply chain issues. They have $50 million in EBITDA, and the stock has gone from $2.60 all the way down to $1.70, despite the fact that the company has had 2 or 3 consecutive quarters of above average EBITDA growth. So that's one. Another one that we own is Potbelly, a restaurant company based in Chicago, but all around the United States. Again, not a company that we worry about when we're thinking about importing semiconductor parts from Malaysia. So as companies are now moving back to full occupancy in their headquarters, as all the banks are calling their employees back, as Washington, D.C. brings back government employees, we think the comp store sales over the next year or two will be greater than the rest of the industry. And we think a restaurant company, a domestic restaurant company like Potbelly, will outperform.
You've been quite vocal in taking a glass half full approach with regards to the Russia-Ukraine conflict and other challenges to the economy. Where do you see the silver lining, and what kind of market rebound are you expecting when we glimpse a hopeful resolution with the war?
Yeah, I don't want to make light of what is a horrific humanitarian issue, and it's sad what's going on there. Unfortunately, if you look back at other periods of time, for us, when we look at the Michigan numbers for consumer confidence, they're literally trading at multi-year lows, and these sort of confidence numbers correlate with the bottoms of stock markets, not the peak of stock markets. So if you look back at the Michigan numbers, in 2008, in 2000, in 1990, in the late 70s, early 80s, when the numbers were as low as they were, that's when the markets bottomed. So, stock market and confidence are, it's an inverse relationship, as you know, and we view that as a contrary indicator. And so for us, it's too much fear out there. People are very pessimistic about the future. And usually that's a time to get more risk on in terms of our portfolios rather than risk off, because valuations are telling us right now that there's better upside today than there was 6 months ago when valuations were a lot higher.
Yeah, that's interesting, Kevin. I picked up on that as well when you had said that confidence is at its lowest, and you also think that inflation is peaking. So this is an interesting inflection point. So how do you navigate with regards to your holdings, and do you see this bottleneck easing up anytime soon?
So look, we're investors and we think about our holdings over a 3-year cycle. And it's very painful to come in every single day and you buy a company like Synchronous at $2 because it's down from $3. And the next thing you know, it's $1.70. And so this is a very fearful market. And we want to take advantage of that fear when valuations are at their lowest. For us, what we always say is investment success starts with the price that you're paying for the business that you're buying. That's the starting point for success. And the prices that we're paying for many of our companies are trading at multi-year lows and in some cases, generation lows. So if you've got a time horizon of 3 years or so, and it may not even take that long, and you believe that inflation is peaking today, then that's usually a good recipe for investment success. And so we think over the next 6 to 9 months, as the year unfolds, the market climate will get a little bit better and a little bit better each and every month. It would be great if Russia would cease from their war with Ukraine. If that was the case, then we can just focus on what the Fed is doing and what's happening with COVID. And we think there would be a huge relief rally for the stock market, to the point where you can get a market up 5 or 10% in a day if Russia sort of ceases from the war. We're not predicting that. We don't know when that's going to come. But clearly, the market is set up for a good period of outperformance because valuations are so low.
It's interesting, Kevin. I'm going to throw one more question at you. Prior to getting the headlines with the Russia-Ukraine conflict, and we know how susceptible the market is to headlines. Of course, the market's always worrying about something. It seemed as if it was coming to terms with itself and digesting the fact, okay, here we are with inflation. We know the Fed is going to move 5, 6, 7, 8 times. And it seemed as if the market kind of got into its groove, and we were waiting for earnings to kick in, and we were waiting for rising interest rates to help tamper inflation. And then boom, we got hit with these war headlines, and it kind of threw off the narrative a bit. It seemed pretty glaring to me anyway.
There's no doubt about it. I mean, people are talking about World War III. And you're not getting any help from China. You're not really getting a whole heck of a lot of help from India. And, I can paint a very dire picture here, that the world now looks as it's a bipolar world between the West and line up the countries that are behind Russia. Whether China admits it or not, they certainly haven't been vocal in their opposition to this war. And that's a scary proposition, because you got 1 billion people there, and investors are also worried about, well, if they're allowing Russia to go into Ukraine and sort of looking the other way, then that'll give them, ammunition to move into Taiwan at some point. And so, there's worries about that also. I would like to think that the sanctions that have been put on Russia is a strong message to China and the rest of the countries that are sort of looking the other way, that you really don't want to look the other way on this one. To some extent, these are war crimes being committed by one person, not necessarily. It doesn't feel like it's the whole country wants to be in this war, but it almost seems like there's one maniacal tyrant at the top who's waging war on the world, and it's frightening. And I don't minimize that. So if it gets worse, the market's going to go lower. There's no denying that, and we're just choosing to take a more of a glass half filled outlook on things, because valuations are so blown up. The Russell's down 25% since November. It's not like this is new news.
Right.
And it's not like the market hasn't digested a lot of really, really bad news. And just one last thing. If you or I were having this conversation around the time that the pandemic started, I don't think that we would have thought that the market could have been up so much a year from March of 2020, but it was. And so times change, markets are fluid, and we don't know what it's going to be like in April of 2023. And with valuations so low, we're being a little more optimistic than we were, say, in the late summer of last year, early fall.
All right, all great points, Kevin. Appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.